Hello, 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 everyone. Mike Arnold here, co-founder, Pat Trading Partners, along with Bob Iacchino. How is everyone doing? Happy Sunday. Boy, this weekend went by quickly. I did just post a sector overview with some thoughts on that. So if you have a chance after this video, please check that out. Good afternoon, Davey, Gary. Hey, did you get on Discord? Patrick. Hello, hello, Martinez. Good evening, Anissa. And to everybody else behind the scenes, thank you for attending and watching. Closing in on 6,000 subscribers. So if you'd like to be number 6,000, please do consider subscribing, ringing that bell, and hitting the ever so popular like the mic button. Who named it that? I don't even remember at this point. Let's just get right to it. All right, Gary. Gary, yes, you're on Discord. It's not that tough to figure out. You should be able to get through it pretty easily, Gary. So, hello, options 22. Where do we sit? Now, this is an interesting week because in terms of financial releases, there is not much. However, in terms of earnings, we have a lot going on. So let's get right to it. The Empire State Manufacturing Index still forecast for contraction, and that is relatively minor. There is little going on tomorrow. So if you're really bored, check that out 1 hour before the open. That is not going to have a huge market impact. Not. Tuesday, we have some industrial production, capacity utilization, the housing market. It's not really going to have a big impact on the markets. So industrial production, whether this drops below zero again, previous was minus 2%. Really, I'm just going to pay attention 15 minutes before the open, well, during a live stream then, whether this goes into contraction again, but very minor. Wednesday, mortgage stuff. Housing market is Mr. Yuck right now. Building permits, housing starts. Again, minor stuff overall. The market's been shrugging off anything housing related. You got all your accrued numbers at 9:30 Central. The only thing I'll be paying attention to really in the afternoon on Wednesday is the Fed Beige Book, and we got Bullard speaking, but that's after the close. So that's the only thing I will be paying attention to on Thursday. Then we have Thursday, continuing jobless claims and initial jobless claims. Remember, based off stuff we follow, we should at some point coming up shortly be tripping into a recession. So those numbers have already triggered that. Other than that, it's just if they miss big. That's the only thing I'm watching in the short term. Philadelphia Fed Manufacturing Index. Prior was pretty significant contraction, still forecasting contraction. That's a minor number also, although we'll be paying attention to the subcomponents with the Philly employment aspect and prices paid and the business conditions, especially business conditions, to see how it relates to previous. Then we have the Consumer Board Leading Index. I want to see if that is still, it's forecast to be in contraction. Remember, these are leading indicators month over month. I want to see if that is still in contraction and if it goes deeper than forecast, because it could then reinforce the continued market rolling over. And then we got a lot of Fed speaky on Thursday. Friday, it's just more Fed speaky right in the morning during the live stream. So that's about it. Again, a much more insignificant earnings or market financial release. Really, the big thing is some Fed speak and the Beige Book. In case you needed a reminder, you get the financials. Decent. Some of the stuff that released earnings. Everything else was a sea of red on Friday. I did release the sector overview with what I was looking at. You see on Friday, sectors were just a bloodbath overall for the week. consumer defensive held up the best, followed by healthcare. And I did give thoughts on those two in the sector overview. FOMC, it's still baked in on that 75 basis point. Not much else to talk about there. We are still in negative gamma. Now, this is changing much more rapidly. I was reading a lot of information how over 50% of the option volume now is based off of super short expirations, like within 48 hours, which drastically changes this and makes hedging for the market makers incredibly difficult. So that's why, I mean, that leads to also some of this volatility. Now, we're in, with the duration of options, we're in uncharted territory. It's never been to this extreme on this short a term, which I think is dangerous with having all these short-term options, because we can continually see this massive volatility. But do keep that in mind. If we do get a rally on, rip your face off, potential rally mode, and decline, rip your face off. And by the way, the green line is wrong. Fear and greed, still an extreme fear. Current market valuations, interesting enough, by the yield curve model, which is one I really like, we're still overvalued. Overall, when you put everything together, we're fairly valued. But some of the subcomponents I pay attention to, with the Buffett indicator, fairly valued, but this still has a fair way. I think before we are well done with this, it will be undervalued easily. PE, fairly valued, but we're really on the high end. I think PE's now, based off everything I'm seeing with interest rates, I think we'll see PEs closer to 12 in the S&P longer term, not for this quarter, but longer term. So those are some things, other things I am watching. Let's see who else is here. Sashi, good afternoon. Good afternoon, John. When does bad news stop being good news? I think we're getting more to that point, Gary. We're getting more to that point. We're not quite there yet, but we're more to that point, that more people are stopping with the pivot. Now it's just banging the drum. The Fed's going to break something. Yes, something will break. But as I asked Jim Iorio on the last podcast, if he was in charge of the Fed, when is his stopping point? Because it's easy to say, I mean, we already know they blew it on with their late rate hikes. So they well blew it. So if they were to stop now, or let's say they do 75 and then stop, and inflation drops to 6% and then doesn't drop more, and you got to wait 6-9 months for the delay, and then it's still high, well, then you've put everybody through 6 to 9 more months of high inflation. Now, yes, something's going to break in the markets, and I think it's going to break pretty bad at some point. But this is all the culmination of easy money policy since the Bernanke era after 2008. So it's going to take some long-term stuff, and you know my thoughts. I talked about it on Friday with where I stand with the Fed. Tomorrow, we got before the open. Now this, as I mentioned, the big week for earnings. This really gets the third quarter earnings season rocking and rolling tomorrow. So this is going to be more market moving from my perspective, especially if you get big beats or big misses. And it's not just that aspect. It's guidance. If there's a key shift in guidance from some of your bigger market players, it's going to impact the market. So this is not a market, even if you're not in any of these individual companies, it can have drastic ramifications on the market going into our earnings season. Tomorrow, we got BOA, Schwab, BNY Mellon before. After the market, we have some more minor banks. Before on Tuesday, we got Goldman Sachs. All right, we have, from a healthcare perspective, we got J&J. We got Albertsons, which is now a story stock based off the merger with Kroger. So do not, and then we got more banks. After the close, we got the Netflix going back to, their, hey, lower cost model with subscribers and commercials. So we're back to the cable model. Which, wasn't that why we were paying for all these streaming services, so we could get away from commercials and pay for content? Now it's like, you want the content, you can pay a cheaper price. We're adding in commercials. We're back to network TV / beginning cable models. We got more airlines. Keep in mind, Tuesday after the close, United, and Thursday before the open, American. Couple biggies there. What else? Oh, great. The war drums are beaten. Lockheed Martin. So that's another thing I will check out Tuesday before the open. After, for anybody who trades like I do with Interactive Brokers, we got that, but that's not substantial market moving. What else is key? Wednesday, we'll be paying attention to P&G, to how much they can pass along to consumers still. Got Ali Bank aspect. We got NASDAQ. What else do we have? Abbott. Paying attention after the close. So no, this will be key for a lot of people. Tesla. Let's see. Let's see if we get any gamma juice with Tesla going in Monday, Tuesday also. If it can be juiced, remember it closed on Friday below a substantial level. Also remember, if Elon's got to sell more, you got to wait till after Wednesday. So that opens up that window, and let's see if they get some. I'm very, I know we got a lot of Tesla fans here. I've been super suspect for years with their earnings reports. I want to see if we're going to have some juice. Let's see how much this one's juiced. Because if you get a pop out of it, you could get Elon selling into it. Would I want to rush in and buy any Tesla based off of that earnings report? No, because we could open up to selling. Other than that, not much. Again, communications. I did give some thoughts on communications in the weekly sector overview with AT&T and Verizon before the open Thursday and Friday. I will be checking in with that. I know we're going to have, not necessarily on this channel, but some of the more retail-oriented people are going to be checking in on Snap. I will be looking at CSX from a transportation point of view. What else? Amex on Friday. HCA Healthcare. So interesting week. And then the following week is even more interesting. But this can get things really going, especially with guidance. Does the valuation need to be undervalued? It's a long way. I think before in what time frame? Before this bear market is over, I think we will be in undervalued for valuations. A lot of people say, hey, well, we're roughly, even with new guidance on the earnings and everything else, with 15 times PE, it's getting priced into the market. Yes, but we have yet to have major earnings compression yet, which I still think is on the deck. And generally, when we're in a more substantial bear market, when the Fed's hands are still tied, when there's not going to be a pivot, we should see an overshoot with earnings compression. And the PE multiple should contract more than normal. What do you mean? How do you trade big moves up or down both ways? Well, it depends what it's in. What's your time frame? I mean, that's a very open-ended question. And that's trader specific. That's why I don't get into a lot of recommendations and what specifics to trade, because that's portfolio and trader specific and time frame specific. It varies whether you're trading for a day, a week, or like your horizon's 6 months or more. How do you trade it? Mike, yes, price action is a tell-all, but given economic numbers, math, and charts, what's going to propel us upwards outside of these BS short-term uptick, short covering illogical rallies? What's longer term? What's going to propel us up to the upside? it right now it's based off of just sediment to the oversold conditions. When it can't go down anymore, you get a few things. This is all gets into the behavioral aspects. We're pinned at cycle bottoms. We're still trying to come, we're back down to oversold conditions. We're holding at key psychological points. So it's generally, if things can get tipped and if we get, next little short-term thing is if we get some eats, remember, some beats, not eats, some beats on some major players in earnings season, and then they don't crush guidance. Because already some earnings have been dumbed down a little. I should say dialed down a little, not dumbed down, dialed down. But I think that's going to be more in the future, substantially more. But if we get some beats by key companies based off of overall market sentiment and technical levels, it could start propelling another rally, another bear market rally similar to the one that kicked off in the end of June, middle to end of June. That being said, long term, it would still be just a bear market rally from my perspective. Are you asking again how you play stuff? Again, that would be on your time frame. So am I looking at any of those stocks to play bear market rally? Well, I'm not looking at Tesla. Netflix that would be more of a longer term play. If I'm looking for things to play any rally with, it's stuff that would be a higher beta. A higher beta than the market. Tesla does technically have a higher beta than the market. But Tesla's not my play in the short term until this Twitter thing's done. What I'll be looking, get an idea for my sector overview also, and then I will be watching for higher beta plays if we do start a rally. I think I answered that. It's going to be something related to earnings. Unless we get some really bad news or a black swan event that takes us into capitulation. If we do not get a capitulation move and we start a rally on, it's going to be from some not so bad earnings or a slight or beats on dialed down earnings and without guidance slashes. Freaking chip stocks, death, crazy. Are you talking the semis? I did cover the semis, and yeah, you might get a rally in semis after hitting that major top targets. However, that's rally for shorting from my aspects. And I did cover transports in the sector overview. Hey ho, waka waka. So, hey, vertical dimension. Tesla is a handicap with this Twitter overhang. Yes, it is. It is. It's why that's got to get out of the way. Okay. Now that we got that out of the way, this is the key thing I'm still watching. S&P on the single bar harmonics and the little follow through rally still. We're still above the 62 on the single bar harmonics off the full rally. The swing low to this little mini swing high. We're still above the 62.5. So the level I'm watching for tomorrow is this on a closing basis. It's 35.88 area, which also on a closing basis, if you look, this is a very key area, not because it's just harmonics. What's our overall closing, our low closing? 35.8850. You get a close below 35.88, that would be a new low close. Also, into the wick from the strong Thursday reversal. That's what I am watching for going in on a closing basis tomorrow. On a pullback basis, if we break down 35.60 is my first support level. For any breakout move, I need to get back above about 36.28. And that was with the remove. So the last two rotations, if you watch, we watch the rotation zone, right? Rotation zone, rotation. Rotation zone, spike up, rotation. What's interesting is if we can hold, again, we're back between the 50 and the 62.5. So I am watching for some support in here overnight. If we break down, besides below 35.60, if we break down below that, I'm watching for the Thursday lows. Technically, if we break below Thursday's lows, the key areas now, this is, let me adjust this. Let me just see where I need to. All right, we can still use the more medium term ones. The key levels I will be utilizing, 34.62, 34.22, majors 3400. Just so happens that's a major key level at this point. By the way, capitulation has to be at least below 3380. And then the next major level is 3295, so roughly 3300. If we do hold, now going into the week, if we do hold this 62.5, we start getting rotation back up. This has been softened now twice with the rotation zone. Also, here's your weekly. Close right on that weekly 200. So tried to flush it and close back on it. So this, again, very key. Could not close below. The S&P is the most important. Of the four, S&P, NASDAQ, Dow, and Russell, this is the most important. Still holding that weekly 200 on a closing basis. Remember, closing prices are the most important. Now, we start taking out that daily rotation zone again. My target, short term, 3,800, then 3,850. Why 3,850? It's declining 50. 50 is not part of any rotation zone. It's a key target level, and it's right around the prior breakdown area. Where does that play in with the weeklies? It's right in the middle of the weeklies. The next target, because we've softened up the daily on a rally, I will watch for a return into the weekly, and the major target area will be closer to this 39.22 area. We got a fake trigger. No, we got a trigger on the Thursdays, and it's still in play. We did not get, on the single candle harmonics, we did not get the close below the 62.5. And on now the ratcheted up, we did not get a close. So there's no fake trigger here. There's an actual trigger, a short-term aggressive buy. And again, remember, anything against your daily and weekly rotation zones is aggressive. Why is it aggressive? As we've seen, now this is still in play on a closing, on a stop basis. Has not been stopped out yet. So that's what's, it's where it is. And with this retrace, that's why it's going to be an interesting start to this week. And if you didn't see me Friday, the market is in we are in low liquidity and very fragile market conditions. Should something come out of nowhere, and I'm not talking with earnings, should there be something that breaks or something that snaps unrelated to the market on a worldwide perspective, we could easily see a flush out move. Overall, I wouldn't worry about missing a 1 or 2 day rally because if we do start a rally on, there'll be multiple ways to participate if you wanted to try to play a end of year rally. From my perspective, you're better, unless you're a more aggressive trader, to sit on the sidelines and wait for more, either the capitulation move or a more stable bottom being put in, at least a short-term bottom. I'm not with Bob, where I do not think the rally will last all through the end of the year. I think if we do get a bottom in, it could easily last through Thanksgiving in the US, possibly into the very beginning of December, and then I will reassess it. What are my favorite days to trade? Any day but Friday, I guess. I find Friday the hardest day to trade, especially from a shorter term perspective. NASDAQ, from the bigger perspective, let me just show this too. You have, oops, didn't want that one. Wanted this one. The NASDAQ still below the 200. And by the way, let me jump back to the S&P real quick. Just wanted to show something from just a pure price action standpoint. Watch about 36.80 on a closing basis, especially for this week. Write that number down. So on daily closes back above 36.80. Why is it 36.80 I'm watching? That's the weekly breakdown area. And you see we closed below that at the end of September. First week of October, tried to get back into it, rejected, and closed back below it. Last week, we got the rally and still closed below it, although holding the 200. So 35.80. That would also be a close back still above the middle of June lows, which set up the last rally. So write down 36.80. 36.80. The NASDAQ, the key area is back at 11,300. Which, interesting enough, if we did get a close above that, that would be an aggressive weekly buy on a percent B basis and back above the 200. And that would be aggressive because it's against especially the weekly rotation zone. We just jump to the Dow because their Dow key area is about 29,870, which again, Dow still also closed back below the 200. So most of these markets, if they can get a rally on, would be back above the June closing basis. I'll keep reiterating this. Close is the most important, and regaining the 200. Russell has not closed below the June weekly close. Still holding up. So the key level to watch would be on sell-off on the Russell with a weekly close below 1664. And the key level on the Russell to the upside is right around 1795. You could go off 1800. 1800 is some key closes here. 1795 is roughly the 200 zone. So those are just from a pure price action standpoint what I'm paying attention to. By the way, the NASDAQ still holding on to a potential double bottom, but that's a long way off. Feedback. Welcome. Given the many options positions are taken based on technical indicators, do you ever use open interest as a sort of confidence? I do not use it as a confidence measure. I use open interest to gauge where key strikes are and then start looking at the delta and gamma aspects of that. I do not use it as a confidence measure. because, and I'll tell you why, you don't know the overall positions, and many people use different options plays for different reasons. Some are hedging, some are speculating. So it's more the ramification of the net options at a level to try to deduce something that's going on. Too many people try to deduce something. Oh, well, I just saw, a huge put, lots of put volume at the 3600s in the S&P. Okay, and oh, that must be a bearish play. Not necessarily. It might be a hedging play. Too many, see, and then this is true on stocks and everything else. You don't know why that position. You don't know the player's net position, and you don't know what they're doing overall. You're only taking a snapshot, and especially with bigger volume at key stuff or open interest, you can have, look, a lot of the bigger players, more often than not, it's hedging versus speculation. So you don't know their overall portfolio structure for S&P and NASDAQ, or even for individual plays, what their overall position is in that stock and their time frame. So yes, it's one less unknown, and depending on who's in power, who is in the presidency for elections, a lot of people favor gridlock, where you have you have Democrat president, Republican House, preferably House and Senate. And I'm not saying that from what I prefer. I'm just saying because then it's gridlock. When the government's in gridlock, a lot less damage can be done. Or a Republican president, a Democrat House and Senate. But also, it's out of the way. It's another, hey, now we know, once, especially a major midterm, now we know how the power is either going to remain or has shifted for the next while. So it's, again, another unknown. Thanks for that information, Walk on the pound. Open interest, just pay attention to the strikes that have the biggest open interest, because those are the biggest options positions. Again, too many people, you can focus on volume to see what's going off, but really at the end of the day, it's what's remaining open, especially for what has to be hedged. And that leads into the gamma moves. So biggest open interest at keys, and that's going to tell you your key levels. And those key levels can be, then you play into, okay, is that going to reduce or amplify gamma? And how's that going to be hedged? How are the market makers or major dealers going to have to play those key levels? Again, just jumping around a bit. Russell, if this pulls back any more on a shorter term basis, it will turn into a triple. But right now, it's still a valid double if it does get a rally on in the beginning of the week. Notes. The double is still valid, long way off. I'm going to see how it reacts around these lows. We should, my next key area, if we break down, is 109.24. I'm not interested in the long side until above 111.16. So not much there. Dollar index, remember, probability wise, we should still see a return higher, at least 114 area. If we start breaking down, though, below 111.90, real 111.80 to 111.90 right in here, We do have the potential double, still a long way off, but that would be very supportive to the market rally. It would be weakening dollar, which is supportive to a market rally. Okay? Do keep that in mind on a short-term basis. So that's what I will be watching for, but I still am expecting higher prices, especially with the move on Friday, which would be more market dampening. Take a look at the VIX, but we still do from a look at it tomorrow, but we still do have a potential double flat top. The gap was filled on Friday, but we still do have a double top. Why be watching this on a slightly longer term basis? Because if we trigger this double top, that we could get into a much more sustainable rally through the end of October / into the beginning of November. So this is going to be key. Excuse me, 2850. 2850 is going to be key to make notes on. Crude watching now above this 89.30 for that's the only thing for a short-term resumption of trend. Otherwise, going to watch for key support 82.77. Also tied in with the dollar, we hit the next key harmonic, this 148.59 area. On a continued march higher, I am prepared at any moment for potential yen intervention by the Bank of Japan, which would probably take us back to only to the breakout area. So yes, it would hurt from the week. It would give strengthening of the yen in the short term, but overall, it wouldn't take us even back below key support. But I am on radar screen. Next target is 149.77. I would be shocked if you don't see intervention before 150. Completely shocked, and that will play into account not only with notes and bonds, because they'll be selling probably U.S. Treasuries to do that. It will potentially short-term have an impact on the weakening dollar. Euro still, my breakdown is 97, breakout 98.20. Other than that, from my perspective, it's caught in this zone. So it's going to take a key thing to get out of there. For my pound rally, I'm watching 113.50 for a resumption to a retest the highs. Other than that, we got an inside bar on Friday, so I will be watching Friday's lows, and then we do that. I will be targeting Thursday's lows back to about 110.60. Bitcoin overall still in major consolidation, so nothing going on from my perspective there. Martinez, I just began trading 3 weeks ago. I found a lot of success in inverse ETF. Why not many people talk about the inverse ETF, and you can do harmonics on inverse ETFs. Why don't I talk a lot about ETFs is because that's not my focus. I focus on the futures. And I still think, if you're playing an inverse ETF on the S&P or NASDAQ or something else, if you're playing an inverse ETF, there's inverse ETFs on everything. It just it's another way to play from the short side without having to short. So you can take any short setups, and as long as there's an inverse ETF for it, you can trade it from the long side with an inverse ETF. There's literally too much to talk about on all the different aspects. That's why I focus on the macro aspects. And again, I've been asked, why don't I focus more so? I will look at, like tomorrow, we'll look at the spiders and the Qs, but why don't I sit and focus on that? Because you get much more reliable information from the futures. You can always execute it with the spiders, or the Qs. But one of the ways I am different from a lot of other people is I'd rather have people focus on. You can get very cheap feeds, even if you don't want to trade the futures. Fine, but you can get dirt cheap feeds, and you can follow the futures and then execute stuff in the spiders and the Qs. And I think more people have better results doing that because you're analyzing a deeper market that trades 23 hours a day. So the spiders key area to watch is 356.42 on a closing basis. That's where I'm paying a closing. And in the morning, that's the first thing I'm going to check for where we trade pre-market. We start moving down. My next target, if we move down substantially, will be 350.88, then a retest of the low area. I'll have to update those levels later on the Qs. The Q's closing below 62.5, so that's already. So on a sell-off, my key area is 256.46. Also, I want to stress something. If you're trying to look at the S&P and NASDAQ, whether you're looking at the spiders, the Qs, the futures between the NASDAQ and the S&P, S&P carries more weight on the patterns than the NASDAQ. NASDAQ has slightly lower probabilities due to its inherent volatility and the way it's traded. That's why I stress the patterns in the S&P over the NASDAQ. Why is Bitcoin not moving much? I think it's really due to before you had a lot of the stablecoin juice and the wash trading with the stablecoins, and they've been unable to generate much with that. Remember, a lot of the up move was done by the wash trading and unbacked printing of stablecoins, and now there's been a lot of interesting stuff with the stablecoins, especially with Tether, and they've not been able to get the juice going. So there's that natural upside bias has been taken away. Other than that, you also have, there's been no upside bias. So a lot of retail has been sort of shrugging it off since it's a consolidation. Now we start getting some candles lit up, you'll have people start chasing it higher again. But that's going to require some kind of bottoming in the S&P and NASDAQ. Where else? By the way, just to reiterate, Tesla. Yes, in case you were wondering, this is a valid potential double on the 4-hour. Anything would be aggressive to the upside. We got earnings, as I said, on Wednesday. The next major target is 194.50 to the downside. Test drove the Q4 e-tron this past weekend. Quite compelling. Yes. Thank you. We have the Thank you for that information. Yes, I am in the market again. For there to be a buy on Tesla, need to close above Friday's high. Well, above Friday's high, that would not only be a single candle reversal %B play, but it would give you a double bottom play. That would require a lot of juice. And we need the NASDAQ to be and the S&P to be putting on a substantial rally. But yes, that would be a short-term play above 222.26, 236.27, 241.27, 246.28 into the daily rotation zone. Would I be holding something Longer term, no, not until this Twitter thing is out of the way. That would, and you don't have the overhang from Elon. I mean, he can always say something stupid, but you don't have the overhang until after Wednesday from him selling. Can't. Then you get the overhang of potential selling after that. So you got to take that into consideration. Is it guaranteed selling? No. Would I know? No. Does anybody know? No, not unless they've spoken to Elon specifically with how he's funding this. And I would not know that. Unless how he can navigate until, well, the banks are still technically on the hook unless there's some, I have not seen contractually how they can walk away. But he can always sell shares to fund it, or he can try more shenanigans. Remember, he's got till, it'll be very interesting with the earnings report from a Tesla standpoint. Are you still waiting for Tesla to reach 69? Was that a Elon 69 joke? Maybe I'm waiting for it to reach 42.0. Yes, I'm still longer term, even once the Twitter thing's out of the way, expecting lower prices. My next key target is 155 roughly. The weekly 200. We will, even once the Twitter thing's out of the way and we get the next major downward pressure in the market, 155 area is my next key target area. And then longer term, longer term, I'm below 100, easily below 100. So let the hate begin. I think the growth story is busted. The valuations are going to have to contract. It's getting harder and harder in a longer-term bear market to play games. Now, if we continue to sell off into this week, if they can't get any go-go juice into earnings, there is very major support at 193, 1 to 194.30. Very major support. Not even, I don't think so anymore based off the way the court played it. The way the court played it, the Tesla Twitter thing with, all right, we're doing a stay. Remember, Twitter never wanted to stay. It was only Elon's lawyers that wanted to stay. And they're like, okay, you got the stay, but it essentially puts it, from my perspective and my reading of it, it put Elon on the hook no matter what to close the deal. If he doesn't want to close the deal, I think if he wants to go back to court, and they continue with the trial, it's going to get shoved down his face whether he has financing or not. And remember, the Chancery Court of Delaware, because his companies are Delaware corporations, they can physically liquidate shares to make him pay for it if he tries to finagle out of this. Do keep that in mind. I think it was a very interesting play. That is my take on it. So I think whether he can get the bank financing or not, it's going to get jammed down his throat one way or the other. Tesla chart looks like a mountain range. I'd call it a rocky mountain range. So that is the overall Tesla analysis. Let the hate begin for the lower prices. Oh, fantastic. I guess it's time to wrap this up for now. Everyone have a fantastic, we're getting all the chatbot stuff in there. It's a very sloppy Head and Shoulders. I was waiting for somebody to bring that up. It's technically triggered. It's technically triggered. If you want to look at it better, look at it on the monthly. Now, I was trying to avoid doing this. Why was I trying to avoid doing this? I really hate the Tesla hate that lights up. I really do. It's very frustrating. Here's your exact. Now, you can't use, again, Tesla's not going to go negative. But funny enough, with this, it's not a well-formed pattern because you got a double and you got a double head. However, what does this reinforce? Because these are key levels. Here you go. What does it reinforce? Well, after you break the 200, see, my price targets are a lot lower, even from a fundamental perspective. I know a lot of people have some price targets still around 150. From this aspect, now this is longer term. This might take a couple of quarters to play out at least. I won't expect this to play out till sometime next year. But the 75 harmonics of 112, the technical target from the sloppy head and shoulders is 107. So that would be after the break of the 200 on the weekly. That would be the next technical target area. And from my perspective, my fundamental targets and the longer term technical targets, you can see that 87.5, and the second target for the head and shoulders is at what, 52.80 to 62.55. And from a long term fundamental perspective, with a substantial recession and earnings and multiple compressions. Now, this is where everything will get lit up from my perspective, but that's longer term target areas for me. But intermediate term for next year, well after the end of this year, would be 107 to 112. No, the final target's -2. What does it? You can't use that target because it. I mean, that would be bankrupt. No. When I've seen this before in other stocks, that's why mostly when you have this, those are the technical patterns, but really focus on this first one. You can also see here, it's a prior major breakout area. And this started all the gamma juice, by the way. This started all the gamma juice. Look at the two key harmonic levels. Breakout zone, retest, and look at how it lines up with just price action. Breakout zone, retest. Fascinating to me. It's just fascinating. Oh, thank you, thank you, thank you. So, if you really want to be bearish on Tesla, you're betting for a bankruptcy. Oh, boy. Now it's going to be me going through comments tonight. Delete, delete, delete. Don't even bother if you want to spew hate or send me an email or do something or direct message me on Twitter. Don't bother. Please. So we have the short-term potential bullish pattern. We have long-term triggered bearish pattern. We analyze both sides of the market. There you go. Yes, I know from the teeth. I know from the teeth. We have it down. You are welcome. Again, I will. It's Amit from another dimension. Oh, yeah, it is. Maybe we have a Twilight Zone tie-in. Sort of the Twilight Zone vertical dimension tie-in. So thank you again. Thank you, everybody, for being here. If you haven't, well, I don't think you could have because we started a live stream right as it went live with the sector overview. But please check out my thoughts in the sector overview. With that, I will be back tomorrow morning, 8 a.m. Central in the chair. We will take a look at the overnight price action and figure out any potential plays for Monday and how we're kicking off the week. Earnings also tomorrow morning, so don't be blindsided. Talk to everyone later. Bye.